Next, let us understand the consignment procedure and certain related terms. Let us say, I'll continue with the same example. Let us say this is the goods and this is Mukta in Mumbai who has a consignment of goods which she wants to sell to, not sells, she wants to send to Kanta in Kanpur. She sends the goods and she sends the details of these goods in what is called a Proforma invoice. So here she will have her address, she will have Kanta's address, and she will have all the details. How many goods, what material, how many cartons, what weight, etc. And also the cost of the goods, details of the goods, including cost of the goods would be there would be reflected in what is called a Proforma invoice. It is not a same invoice that a seller gives to a buyer. It is only a Proforma invoice because there is no actual sale transaction. It's a Proforma invoice, a format of an invoice which has the details of the sender, the details of the buyer, and basically contains the description and the cost of the goods being sent. And let us say, like we said, transport costs may be incurred to transport this 1 lakh worth of goods from Mumbai to Kanpur. There may be many other expenses. There could be insurance in transit. There could be duty, customs duty, whatever costs are incurred by the consignor to send the goods to the consignee. So these goods will now reach Kanta, the consignee. The consignee will now take these goods to his or her warehouse, shop, go down, whatever, in order to store the goods before sales is actually effected. It is possible that there are some expenses in transporting, and let us take the example of rupees 5,000 being consignee's transport expenses. Thereafter, the consignee will try and sell these goods either for cash or for credit as per the agreement at the prices as discussed with the consignor. Once goods are sold, at the end of a period, maybe a month, after 10 days, or after all the goods are sold, whichever, the consignee has to inform the consignor about sales, etc. So what Kanta does in this particular case is sends a statement called the account sales. What does this contain? This contains the details of the sales made, the price at which it was made, the commission which is therefore due to the consignee, details of any advance. Very often what happens is when goods are being sent by the consignor to the consignee, an advance, a bill of exchange, or some portion, 70 or 80% of the value cost of the goods is sent in the form of a check, in the form of a bill to the consignor, since so much worth of goods is being received here by the consignee. Details of the advance, any expenses which need to be reimbursed, expenses which are incurred by the consignee will be reimbursed by the consignor, details of the expenses and the balance which may be due to consignor. So what has happened? Here Mukta has sent a consignment of goods. This Mukta is the consignor, has sent a consignment of goods along with a proforma invoice incurring transport charges to Kanta the consignee. The consignee incurs some expenses in getting the goods up to the warehouse. At the warehouse, she may incur some expenses on maintaining the goods, maybe insurance, maybe warehouse rent, etc. There may be other expenses of the consignee here after the goods reach the warehouse. The consignee will then sell the goods. On such sales, either after complete sales or periodically, a statement has to be sent by the consignee to the consignor. What is the statement called? It's called an account sales. Account sales is sent by the consignee to the consignor, informing the consignor that so much is the sales made, so much were the expenses which were incurred, this much is the expenses, so much is the commission which is due, so much may be the unsold inventory, and therefore what is the balance due to the consignor. This is in brief the procedure, the consignment procedure and some of the related terms. So a quick recap. What is a proforma invoice and who sends a proforma invoice? A proforma invoice is sent by the consignor to consignee. What does it contain? It contains the description of the goods being sent by the consignor to the consignee and the cost of such goods. While sending these goods, the consignor may incur some expenses. These expenses are normally called direct expenses of the consignor. All expenses of the consignor are included when we value closing stock. Direct expenses, these may be recurring expenses or non-recurring expenses, but all expenses of the consignor in sending relating to the consignment of the goods is included in the cost of goods when we need to value consignment stock. The consignee too may have expenses. The consignee's expenses are sometimes split as recurring, that is expenses which the consignee always incurs, and non-recurring expenses. It may be noted that usually the consignor and the consignee both have their own independent businesses. As part of the consignor's business, consignor is sending the goods and trying to sell the same goods in Kanpur. In Kanpur, Kanta probably, the consignee probably has his or her own business. And in addition, she tries to effect sales for Mukta. Now, the non-recurring expenses, actually, when you value stock, consignment stock, all expenses which are incurred by the consignor or the consignee up to the point that the goods reach the godown of the consignee, reach the warehouse of the consignee, up to the point of storage, all these costs are added in order to value consignment stock. What is consignment stock? The stock which has been received from the consignor and has not yet been sold. Basically, the closing stock on consignment. Sometimes in a question, it is not given in detail what the nature of the consignee expenses. That is why here we are making a split. where there is a recurring expense or non-recurring expense. So the non-recurring expense, if it is specified, is added to value stock. But the recurring expenses or selling expenses are not included in the valuation of the closing stock. After the goods reach the warehouse of the consignee, if rent is paid, if insurance is paid for storing of the goods, these are not included as part of the cost of the consignment stock. But whatever the consignee's expenses, these are reimbursed. Usually by agreement, these are reimbursed by the consignor. So the goods have been sent. Proforma invoice was sent by the consignor to the consignee detailing the goods, the description of the goods, including the cost of the goods. The consignor may also incur some expenses in sending the goods. The consignee again may incur expenses in transporting the goods to its godown and may also incur other expenses on those goods after the goods have reached the warehouse. Usually, the consignee may give an advance to the consignor since a large amount, since 1 lakh goods is being received by Kanta, it is possible that on receipt of these goods, Kanta sends a bill of exchange for rupees 75,000, 75% of the cost of the goods, though Kanta has not yet sold any of the goods. If the consignee is not able to sell the goods, the consignee can always return these goods to the consignor. This is the format of a proforma invoice. The name and details of the sender are here. This is the consignor, sent by. So that's the consignor, sent to. The details of the consignee, details and address of the consignee, the number of pieces, 6,000 mobile phones, the weight, the net weight, the carrier, how it is being transported from where to where, and again details including the total value of the goods. This is how a proforma invoice might look, sent by the consignor to the consignee. Now, what are the other related terms? We said that the consignee is entitled to a commission. Commission again may be ordinary, may be del crede, or may be overriding. What is ordinary commission? A commission of, let us say, 5% on sales. This is the commission which is being paid by the consignor to the consignee for the service of sale that the consignee does on behalf of the consignor. So the consignee is selling goods for the consignor and therefore the consignee gets a commission that is called ordinary commission and calculated on sales, on total sales. Now let us consider a situation. Kanta, as we said, had received these goods, and if Kanta is not able to sell these goods for some point of time, suppose Kanta were to ask her friends to buy the goods and she is willing to extend credit to them. So she says, you can come and buy goods from me, I'll give you credit. It is okay. Actually, she does not, she may not mind even if money is not collected because she gets commission on sales effected. Any losses, bad debt losses are actually borne by the consignor. In such a situation, or to avoid such a situation, sometimes the consignor offers an additional commission, in addition to the ordinary commission, offers a del credere commission. So in addition to, let us say, 5% commission, a 2% commission is given by the consignor to the consignee as del credere commission. What is the implication of a del credere commission? This, as a result of the del credere commission, any bad debt losses will have to be borne by the consignee. So the consignee would be responsible for the credit sales and any losses which arise as a result of the credit sale. For bearing this risk, the consignee gets an additional commission called del credere commission. Mind you, normally ordinary commission and del credere commission are both computed on total sales. On total sales. Del credere commission is a commission so that the losses on account, bad debt losses on account of credit sales will not be borne by the consignor but will be borne by the consignee. But this del credere commission is computed on total sales and not on credit sales unless otherwise specified. So overriding commission is additional commission in order to promote sales. Normally it is paid when the consignee is able to sell the goods at a price higher than that which has been suggested by the consignor. So we have an ordinary commission which is paid for the service of sale which is being rendered by the consignee. We have a del credere commission. When a del credere commission is paid to the consignee, the risk of bad debt, the risk of loss due to bad debts is to be borne by the consignee, not the consignor. If del credere commission is not given and there are bad debt losses, these are borne by the consignor. Overriding commission is an additional commission largely to increase sales, increase profit. It is normally given when the prices are higher than that expected by the consignor. Next, what is an account sales? An account sales is a statement which is sent by the consignee to consignor. What does this contain? This contains the details of the sales made, the quantity of stock which is not sold, the expenses expenses incurred by the consignee which need to be reimbursed by the consignor, the commission which is due to the consignee, any details of advance which the consignee has already paid to the consignor, and what is the balance due to the consignor. So usually the account sales contains the balance due by the consignee to the consignor. It is a statement sent by the consignee to consignor. Unsold inventory, it's also called consignment stock, when goods have been sent by the consignor to the consignee and the entire stock is not sold by the consignee. Some stock remains in the warehouse of the consignee, but this consignment stock actually belongs to the consignor. If the accounts are being closed and physically goods are counted in the premises of the consignee, this consignment stock is physically there, but it should not be included in the stock of the consignee. Similarly, in the books of the consignor, when physically stock is counted, the consignment stock is physically not present in the warehouse of the consignor, but this consignment stock must be included as consignment stock as an asset in the books of the consignor. Let us look at the format of a account sales. Account sales, as I said before, is sent by consignee to consignor. And what is sent by the consignor to the consignee? A proforma invoice is sent by the consignor to the consignee. The consignee, after effecting sales, sends a account sales, a statement containing the detail of the sales made, containing the details of the expenses paid, containing the detail of the commission due, and therefore what may be the balance that the consignee owes to the consignor, since goods are sold by the consignee on behalf of the consignor. This is an account sales. There is also mention, if you notice, of the unsold stock. So this is the total sales value. These are the expenses which have to be reimbursed. This is the commission which the consignor has to pay. So out of the total proceeds that the consignee has collected, in this example of 68.5 lakhs, 5.8 is the consignee's share of expenses as well, which need to be reimbursed, and commission which has to be paid to him. Therefore, only the balance amount of 63.32 lakhs is to be given to the consignor. Maybe along with this account sales, a check would also be enclosed containing this balance amount. Detail of the unsold stock of inventory is also mentioned in this account sales.